I'd like to thank you all for joining us. I'd like to thank my staff, obviously, for putting together a great event. But I'd like to thank you, first of all and foremost, for joining us and making this event another success. And of course, I'd like to thank all the sponsors who have helped us and make this event possible. It is year number 18 that we're holding this event. So if you allow me to share my pride for being able to keep this event going for 18 years. I think this event has managed to become one of the key industry events. And I think right now we are, if I'm not mistaken, the only private sector initiative promoting the closed-end fund industry and, of course, other investment vehicles like BDCs, MLPs, ETFs, and so on, and providing to advisors and investors a wide range of options that they can use for their clients' portfolios. So we're very happy also to work together with the Closed-End Fund Association. There is strength and unity to promote the sector. And with that, I'd like to welcome you all. Thank you again, and turn it over to John to open the Closed-End Fund Roundtable.
Thank you, Nicholas. And thank you all for being here today. I'm happy to be hosting the panel. As you might have noticed, it's got a very broad name, Industry Roundtable, so we have a lot of leeway to touch on a bunch of topics, which is good given the experiences of the panelists. Thanks, Nicholas. Just a brief word on my own background. I am an analyst in the closed-end fund and ETF research team at Morgan Stanley. I concentrate primarily on bond funds. In that group, we cover approximately 100 closed-end funds across categories, and we're located within the Wealth Management Investment Resources Department of Morgan Stanley. What I'd like to do now is just go straight to the panelists, ask them to each introduce themselves and say a word or two about their firm as well.
Thanks, John. My name is Bob Bush. I'm a director of closed-end fund products at Calamos Investments. Calamos has about 23 billion assets under management. We're headquartered in Naperville, Illinois, but we have offices in Chicago, London, San Francisco. We're a global manager. We have about 7 billion in closed-end funds. We've been an issuer since 2002. It's a very important business for us. And through our funds, we manage convertibles, high income equity, and also we have a convertible ARB strategy. So it's sort of a multifaceted approach through global funds, but also domestic funds as well. So we've got a booth outside and happy to chat with you about that if you'd like.
Hi, good morning. My name's Jonathan Isaac. I work at Eaton Vance, where I'm Director of Product Management. I've been involved in the closed-end fund world since about 2003. Eaton Vance runs about 470 billion now between retail and institutional assets. And we manage in the open-end, closed-end, and separately managed account world. And maybe important to say, the same managers are managing in all three of those worlds. There are not particular managers for the closed-end fund space. Our closed-end assets are, I think, around 23 billion, which I think makes us around the third largest of closed-end fund asset managers. Our first fund was launched in 1998. And we really manage closed ends, I think, across the board and across the spectrum that we manage other assets. So we have municipal funds, we have bank loan funds, we have taxable fixed income funds, and varieties of equity funds as well. And kind of, I think as Bob alluded to, we take the support of those closed-end funds trading in the secondary market very seriously. We try to communicate through our extensive wholesaler force in the field. We have a good web presence, I think, in terms of data and information around all of our products. And we think things like this are very important as well, sort of industry organizations, a day like today, an organization like the Closed-End Fund Association, really any opportunity that we get to get in front of investors like you, we think is very important.
Hi, I'm Janis Kerns, and I'm the General Counsel of Adams Funds, and we are a two-fund complex. We are two of the oldest closed-end funds in the country. We're 90 years old this year. Both funds were launched in 1929. We have about $2.5 billion in assets under management. We have a large cap equity fund, which is just under $2 billion, and we have an energy sector fund that's around $600 million. And I like to tell everybody that closed-end funds have been around since the 80s, the 1880s. They have a very long and proven track record, and my co-panelists here are kind of a culmination of that. And we were there at the beginning, and we like to think that we have helped bring these guys into their success.
Not the 1880s, though. We weren't around for that.
None of us were, thank the Lord. But yes, it's a very old and proven model, and it's fun to be a part of that. So.
Thank you, Janis. Jonathan, it's been a really interesting last 6 months in the secondary market. Obviously, part of that was affected by tax loss selling, but also some tremendous moves in the underlying markets. Can you kind of walk us through that and give us your thoughts generally on the secondary market?
Sure, and I think when we had a chat to discuss this session, I used the term of roller coaster ride, which I feel like what we've been on for the last, as you say, six, probably almost exactly 6 months. The end of last year, both in October and then again in December, saw, I think, sell-offs in the closed-end fund secondary market, the like of which we'd not seen probably since the financial crisis. Average discounts, and just for reference, I think average discounts over the long period of time are around sort of 5%. Average discounts across all, whatever it is, 500 existing funds got to levels of 10% discounts on average. What was going on was I think a mix of what was affecting the underlying asset classes involved, where, as you're all aware, several took a huge tailspin. The equity market, what was going on in the bank loan market and other credit markets at that time. Sprinkle in great uncertainty again at that time around the direction of rates, and particularly to the closed-end fund world of short-term interest rates and the impact that could have on the leverage that many of these funds use. And you had what I would say, and I think I referenced earlier, I've been working with these products since about 2003, is a classic closed-end fund, throw the baby out with the bathwater. Everything, regardless of what it was invested in, got sold. As John said, you had, in addition to that, tax loss selling, which has always been a factor in the closed-end fund space to the extent that there are losses to take. But I think what we saw was, first of all, the sell-off in October, and then those people who wanted to take further losses then did so again in December, which saw these levels become quite extended. And then we had a turnaround, and that was, I think, mainly driven by, I guess one could say, three things. One was just the turnaround in the direction of the underlying asset classes in which many of these funds are invested in themselves. That obviously helps bolster net asset values, which helps bolster the market prices that are attached to those. You saw more clarity and maybe signs of a halt in the direction of rates, or short-term rates, which again I think gave people some comfort that perhaps their fears about the cost of leverage and the associated effect on the dividends in many funds was maybe overblown. And then I think thirdly, and maybe most importantly, you saw profit taking, or profit, value driven investing in the people who have been around this market for long enough know that when you get to those extended levels, there is a massive opportunity. And I think, again, we've seen that time and time again in this space. I think today we see discount levels, again, on average around 5.5%, so very nearly back to what I would say is sort of historical norms. People who took advantage of what we saw in either October or December, I'm sure are pretty happy with what they've experienced, both in terms of the just underlying asset class recoveries that we've seen, but also the recovery in those closed-end fund prices in the secondary market. The sort of outlook from here, which I'm sure we'll talk about some more, I think will depend a lot on the further direction of rates and people's comfort with that. I guess one more thing to maybe mention in this is the recovery in the municipal funds, which I think got particularly badly hurt towards the end of last year. We manage municipal funds both in the open-end fund and in the closed-end fund space, and I think a lot of what we've seen on the sort of tax front, some shocks that people have experienced as far as their taxes for 2018 have driven flows into both the open-end mutual fund space of municipals, but also in the closed-end space. So a combination of all of these things has led to a nice recovery year to date.
Thanks, Jonathan. Eaton Vance is one of the few firms that has closed-end funds across the three main areas of equities, munis, and taxable bond. Do you think there's one area there that stands out in terms of value more than the others, or perhaps a category or two within one of them?
Sure. I think, just going back to that recovery, I think that recovery has been pretty broad-based, or at least in our experience, it's been pretty broad-based. The one area that it has not occurred would be in the bank loan space, where there has been a recovery in the underlying asset class. I think prices of bank loans in December got down to maybe 93 cents on the dollar, something like that, and have traded back up, maybe not to par, but to pretty close to par. The associated closed-end funds invested in those bank loans have not recovered. I think discounts in that world remain in the 10, 11% kind of range. I'm sure a lot of that is associated to views on what the Fed is going to do. I think there's an association between, these are floating rate funds, therefore I can only invest in them if I know that short-term rates are going up. My personal view is I don't think short-term rates are going down anytime soon, and these funds are paying, I would say, pretty attractive dividends at the current levels that they're at. As we say, we've seen a great deal more solidity in the underlying asset class, so I'd say that seems to me to be an area that there is still opportunity.
Thank you, Jonathan. Bob, I think that leads us naturally into the primary part of the market. There's clearly been some important developments there. Can you kind of take us through them and give us your thoughts as well?
Sure. So a year ago when we were at this conference, I remember a fellow panelist made the comment that the closed-end fund market is broken. And I know what he was referring to was the IPO market. We just weren't having new issuance coming out. There was the concern about these funds coming out. They would immediately go to discounts because of the load that was taken off to compensate the underwriters and for other expenses to get these deals done. So after they came out of syndicate support, they would immediately trade down to what their NAV was. That was a conundrum. What the market, the closed-end fund market, has done, and I think it's pretty ingenious, and it's a very sturdy market. It does rise to the occasion when it sees that there needs to be changes. And so what the industry now has come to is the IPOs that have come out in 2019 have effectively been no load. The load, the expense that would ordinarily be borne by the shareholder on the IPO is now being picked up by the sponsor. So in essence, when these funds come out, their initial IPO price will be the same as the NAV. They'll be flush. And what we've seen is those have traded very, very well. You saw part of that in the preceding years with some of these term trust deals being done, these 3-5-year bond deals being done, where part of it was subsidized, but not the entire portion. To help the underwriters, I should say, to help the sponsors recover from that, these terms now have come out a little bit longer, so they're no longer 3 or 5 years. Now the market really is saying 12 years, so it allows the sponsor to recoup that initial upfront expense. I think the good thing about that is, too, what it's done is it's allowed the market now to expand, not just being in fixed income deals, the 3 and 5 year term. You really can't do an equity fund. It's hard to do an equity fund with a 3-5 year term because God forbid you come out and the market bombs. You'll never really be able to catch up. But 12 years gives you enough leeway, I think, to be able to make good on it. So what's happened is PIMCO came out early part of this year in January, and they raised about an $850 million deal, which really, through this new structure, through an energy deal. And energy had done well in the month, so it was a good product for them. It was a good time for it. That's traded very, very well. You've seen Tortoise now come out with a necessary assets deal. That was earlier in the spring. It was a smaller product, raised about $150 million, but that is doing well as well. So now it looks like the market's beginning to open up with this new term, in essence, a no-load structure. And as you look at the business, the industry in general, this is really where we are going. I mean, you see these ETFs now that are in essence free. The margins are coming in quite tight in many of the financial products. And all this is a result of the DOL issues that came out over the course of the last few years. Now that's gone away, but what hasn't gone away is the necessity really for the advisor to justify what their fees are, what their expenses are. So that's put some pressure on the industry, which candidly I think is a good thing. We should be able to justify why we're charging what we're charging. I think coming out with a no-load product is great. And I think if it helps revitalize this business, revitalize this industry, be able to supply new products to our customers that are contemporary and have a reason to be, given the particular economic environment that we happen to be in at the time, I think it's all very good. So we're excited about this market being revitalized, and I think that's a large part of it.
Can I just make a couple of comments? I think one of the most encouraging things is the fact that this happened in January of this year with the backdrop of what I just described going on at the end of last year, and the fact that deals could be done when everyone had just experienced the trauma, for want of a better word, of what had happened in the secondary market that time. And I've managed to speak to a couple of people involved on kind of either side of the deals that have got done and sort of ask them, what is it that has changed things? What's made these attractive? Is it the length of the term? Is it the product itself? Is it the pricing structure? And I think in every case they've come back and said it's this new pricing structure, which I only somewhat chuckle at in that I think when we did our first fund in 1998, that's kind of how they worked. So it only took 20 years to get back there. But it is nice to see the primary market working again.
Bob, I think one of the things we heard a lot about, I'm going to say starting 4 or 5 years ago, was demographics. And retirement of baby boomers, for instance, could lead to a wave of demand in closed-end funds. Do you think we're starting to see any confirmation of that yet?
Well, I think, yes, to answer your question, obviously the baby boomers are getting older, they're retiring, you're seeing more come out. The need for income continues to be there. Clearly, interest rates aren't going anywhere, at least anytime soon. In fact, if you had to handicap what the Fed does, the greater likelihood of them cutting rates is again, higher than maybe you're increasing rates. So that need for income is going to be there, and like I said, it's not going away anytime soon. So that's an inherent feature of the closed-end fund product that's going to offer demand. I think to Jonathan's point, clearly this product showed its resilience at the end of last year when there were times when it may have stayed at deep discounts. It may not necessarily recover, but I think that demand that is out there, given the demographics in the country, and I also think, although the IPO market is being revitalized, it's still very low relative to what it's been over the last 10 or 15 or 20 years. We remember deals, months were coming out where there were $4 billion of new product being done per month. Right now, like I said, PIMCO, really rocked the waves with an $800 million deal done in 1 month. So I think the lack of new supply is also helping support the secondary. So I think you're right. I think, clearly, the demographics are supportive of these products. No question about it.
Thank you, Bob. Janis, would love to hear your thoughts on either of our 2 main topics, primary or secondary. Also, I understand there has been some development on the regulatory front. I think some of the issues have been a little bit under the radar. If you'd like to touch on those as well, that would be great.
No, sure. And the regulatory reforms primarily affect the secondary market, of course, but there are a couple of 3 things out there I'll touch on very high level, but they're kind of exciting because mostly no reforms are pushed out in this area. But there are 3 different things right now. The SEC has proposed a couple of different rules, one on offering reforms to make it easier to bring closed-end fund deals to market. They have also introduced rules to level the fund of funds playing field so that there is a standard set of rules, and there's a little bit of controversy out there. So I think that rule may have a longer time horizon before it gets into the markets. And then there's a proposal out there to permit closed-end funds to test the waters. so that you can come out quietly without landing something, publicly with the SEC, but you can gauge interest in the product that you're trying to bring to market. And all of those things, I think, will bode well for closed-end funds going forward.
Thank you, Janis. Just kind of circling back to broad categories, you mentioned, Jonathan, how much of a bounce back we've had. I think one of the areas that's had an even bigger bounce back relative to its own history and the type of assets is the Muni Funds. And I think one can make kind of a call at this point that there's still value, although there, obviously there are risks out there because those are always long duration instruments, especially the ones that use leverage. So if any of the three of you have thoughts there, I'd love to hear it.
Yeah, I think, I just maybe add to what I said earlier. It's always interesting when you manage money in the open-end world, closed-end world, and elsewhere, just to see correlations in terms of where investors seem to be going. And we obviously get the opportunity to do that. And I'm sure many of you have seen what's been going on in the open-end fund world with municipals this year. I think it's the first time in a long time, certainly, that long municipals have been getting net inflows, and I think we're seeing a mirror of that in the closed-end world. It kind of tails into a topic that I always think is a useful one to talk about at these kind of events, which is how do people use these things, or how should people think about using closed-end funds? And the way that I think about that, if we apply it to municipals, is kind of depends what you want from a risk standpoint. As you know, you've got various different durations of municipal funds. You've got various different forms of credit in them, from investment grade to junky high yield munis. And what closed ends bring is that variation, if you want that variation, but with the additional opportunity that leverage brings. So rather than taking credit risk, you're taking a different kind of risk. But if you're looking for a higher yielding municipal opportunity in the portfolio, you can decide, do you want to junk it up? Do you want to take some more risk with leverage? And that's, to me, the opportunity that closed-end funds provide, not just in munis, but in a lot of the other areas that we manage closed-end funds. So I think, as you say, I think uncertainty about taxes is not going to go away. I think everything that's associated with this whole SALT business is obviously hit people pretty hard. So assuming, and it's a big assumption, but assuming that rates, both short and long, cooperate, I think you're right that there continues to be an opportunity in the muni space.
I'll just chime in real quick. Calamos is a leader in the convertible market. John Calamos started the firm in 1977, and convertibles is sort of our DNA. It runs through all that we do. I think the one nice thing about that product is that it does very well in a period of volatility. We are actually able to capture a large part of the upside of the equity market, but to do it with downside risk because you've got that bond component to it to offer income. So I think if you are hesitant about getting involved in fixed income, you're hesitant about high yield credit, you're hesitant about investment grade that's longer duration, but you want to be in the equity market and still get some income. I think volatile times that we may see this year for the balance of this year and maybe going forward, I think convertibles is a great opportunity.
Thanks, Bob. Yeah, just touching a little bit more on the munis. I know there's risks. I know there still might be some pressure on some of the dividends, even though borrowing costs have flattened out. But it's pretty striking to see the discounts in that area still, given the wave of inflows we've had on the open-end mutual fund side. So I think that's pretty interesting. Bob, another thing we had discussed earlier in the week was your take on Z-scores and how that can be a valuable valuation tool. Would you mind touching on that?
Sure. So one of the things that we try to do as service providers and with the folks in the panelists as well is we come to these events and we talk about the closed-end fund business. Why? Because we think it's the right thing to do to support the industry, but to support our clients, because we think an educated consumer, Cy Sims was a clothier, used to say that in New York, the educated consumer is our best customer. We think the same way. And so along those lines, when there are opportunities out there in the closed-end fund space, and there are wonderful opportunities, not only with respect to the underlying assets, but the vehicle itself, which we saw at the end of last year, when you saw in the fourth quarter, for example, the NAVs dropping maybe 10 or 15%, but the stock prices were down double that. Now, if you don't think the world is going to come to an end, and you like the asset class, but you see how the stock has been beaten down relative to what the NAV is, it really can be a very, very opportunistic time to get involved as an entry point in some of these vehicles. And so one of the things that is a measure of what the value proposition is what we call sort of the Z-score or the Z-factor. And what that does is, and I'll tout Naveen because on their closed-end fund website, or actually CEF Connect, they show what these Z-scores are for each fund out there. And I use that as a wonderful example. So a Z-score is basically taking the current premium or discount, subtracting the average premium discount of whatever period you want to look at, and dividing it by the standard deviation of that period. And what that will do is that'll give you a Z-score. And that Z-score, if you think in terms of a normal distribution, all right, where the events will come out normally distributed. If you get a Z-score which is more than 2 standard deviations one way or the other, that means that tail only happens 2.5% of the time. 95% of the events will occur in the middle. So what you saw was, at the end of last year, Z-scores approaching -2. Which means relative to how they trade through the history of that particular fund, they are really showing you wonderful value. And so we have these conversations at Calamos when we do our closed-end calls quarterly. Like I said, Naveen shows this on their website for each, not the website, but the CEF Connect site that they monitor. And certainly if you call up any one of us here at the table, we can tell you what our Z-score is for any fund that we have. So it's a really interesting way to associate value, because again, people will look at discounts and look at premiums and so on and so forth, and some funds trade, their average trading range is maybe 2 or 3% premium for their life. Other funds may trade at average discounts 5%, okay? But just looking at that is not the way to look at it. What is its relative value to how it trades on an average? And that's what the Z-score supplies. So if you're truly serious and interested in understanding this business, understanding this product for yourself or your clients, getting a grasp of that and evaluating that on a regular basis is a very important factor. Now, that doesn't say you don't look at the underlying, of course. You got to be, anytime you buy any product, closed-end fund, you have to be supportive of what they're investing in. Do I like high yield? Do I like convertibles? Do I like equity? Do I like global? Whatever it is, that has to be the first and foremost. But then you peel the onion back and say, okay, fine, if I want to get into this, where's the value in XYZ closed-end fund?
Yeah, I couldn't agree more with what Bob just said. I think the only thing I would add, which again I always try to say when talking about closed-end funds and this business of peeling back the onion, to really kind of dig into what they are, because there's a lot of funds out there, a lot of sponsors to choose from, but focusing on net asset value performance. Ultimately, that's the best way to judge what you're owning or what you are looking to potentially own, because that's what the investment manager is actually doing with the portfolio, not any different than, say, an open-end mutual fund, which is probably the first thing you would look at is NAV performance. So as frustrating at times like October or December, as frustrating as market price movements can be, ultimately, if you want to know what is going on under the hood of any closed-end fund, the way to try and judge that is to dig into I would say long-term net asset value performance, because that's ultimately the performance of the manager that you're buying.
And that's what you saw at the end of the fourth quarter. You had many of these closed-end funds were actually outperforming on a net asset value basis relative to their index, whether it be the convertible index, the S&P, the MSCI. They were outperforming it, but the market was bidding down the price more than double what the decline in the NAV was, which is really when these opportunities present themselves, because the fund is doing what it's supposed to be doing. It's actually doing better than what it's supposed to be doing. And many of these have leverage, but they were still outperforming relative to their index. But the market was bidding them down. Why? Because it was year end, it was tax loss selling, there was window dressing going on with respect to some of the portfolios. And also when volatility strikes, this is predominantly retail product. And if they need cash and they have Apple Computer here and they've got XYZ closed-end fund here, they're going to dump the closed-end because 9 times out of 10, many of them don't even know why they're in it or they don't understand what's in it. And they're certainly not going to sell Apple because they look at their Apple phone all day long and they know that's not going anywhere. So the NAV is really the driver, and that's the critical component of these products and how to assess their productivity.
Thank you, Bob. Nicholas, did we want to turn it over to some audience Q&A, or? Yeah, that would be great.
We got a couple back there.
Hi, I was interested in the comment on NAV performance just now. How would you suggest we measure closed-end funds when many of them don't provide a benchmark to assess that NAV performance?
I'll take a stab at that. Many closed-end funds are what I will say are hybrids. In other words, they aren't necessarily a straight equity fund. In other words, they're not an ETF like a SPY, or they're not a high yield fund that are completely investing in high yield. Many of them are hybrids that can invest in a number of things: convertible, high yield, equity. So it's a bit of a challenge to assign a specific index to that. What we will do at Calamos is, for example, for our closed-end funds that happen to be hybrids, part of them can be in convertible and high yield, we'll do a 50-50 measure on that. So that's our own internal way to do it. I think if you want to look at it from maybe a more industry practice way, Morningstar assigns categories to each of these closed-end funds as they look and see in their own assessment, for what that's worth, as to what their real peer group is. And you can get information out there that will show how these funds perform both on a net asset value and an equity basis based on their peer group. So I know that's not a clean answer, but many of these funds are really designed to be hybrids and do multiple things at multiple times, getting into multiple asset classes, which makes that more difficult.
And I'll give you a simple example. For Adams funds, our energy fund is 80% exploration and production and 20% materials. And we create a blended benchmark that we put out in all of our literature and on our website. So, and it's all equity, it's all energy in various sectors of that, subsectors, I should say. But so we are one of the funds that will create those blended benchmarks, but it's not, we are in a much simpler structure than these multi-asset class funds.
Yes, I'm wondering how you assess the new legal risks to owning municipal bonds that flow from the outcome of the Puerto Rico sales tax bond case. The bankruptcy court in Puerto Rico approved the settlement, which basically wiped out half of the value of the junior sales tax bonds, the lien that they had on the sales tax collections. So that seems to me to introduce a new risk to owning municipal bonds, risk of legal developments, as compared with, we always understood the risk of interest rate changes and default on the part of the issuer, but now we have the courts involved in ignoring senior liens, not giving them full credit.
I don't know whether Morgan has any views on that, John. I mean, I would defer to municipal investment team back in Boston and be happy to follow up with them if you want to grab my card afterwards. Do you have any views on this?
Well, you know, we obviously talked to a lot of PMs on the Puerto Rico front, and we have for the last, 2 years now. Very, very complicated and changeable situation. We're still hearing there is value in some Puerto Ricos. You just have to be very careful which ones you select. But I understand it's a fluid situation, and I would have to defer also to our muni strategists and circle back on that.
Hi, thank you. The perception in the market has been there for quite a period of time that investors aren't being paid to go long-term in any debt instruments. I would ask the panel, what do you see as the sweet spot in duration for various classes of fixed income, and do you see that changing in the future at all?
Well, I think a lot of people have come back to the point that it's important to have balance, and you can argue for value on different parts of the curve. We as a firm have inched out towards the longer end lately, and I personally think it's a compelling case can be made for having some kind of money market plus type instruments that are going to give you a 2+ handle, as well as going far out on the end of the curve to get that balance and diversification. I don't know if your firms have.
Yeah, I mean, I think that's a good strategy. I think we, as an organization, have been talking for probably a long time here about the importance of having lower duration assets in portfolios, and that happens to also be a somewhat of a sweet spot for us. But clearly, when the valuations become attractive enough, it makes sense to extend those durations in certain areas as well. So, yeah, a sort of barbell approach, I think, makes total sense.
I mean, you make a good point. It's hard-pressed to think in terms of going out 30 years when you can get a very similar yield at a 2 or 3 or 5-year level. So, I mean, our thoughts are, on a macroeconomic perspective, we are going to see some slowing here across the globe. You're certainly seeing it in Europe, you're seeing it in China, and I think that will start to impact the U.S., although you've recently seen earnings beats in the first quarter. You have to realize those beats are because those earnings have been reduced largely from where they were in the fourth quarter and the third quarter of the prior year. So I think the question now is it worth the risk to go out there? As I said earlier, I think that there's more likelihood that you'll see rate decreases going forward than rate increases. And if that's the case, I think perhaps you really have to think in terms about going anywhere far out on the yield curve. But again, it's all a value proposition. It's where you get in.
Investors get frustrated with the discounts on closed-end funds, and despite all this happening, there's been very little happening as far as changing the structure to be more reflective of net asset value, or basically changing. I know there's been a few closed-end funds that have done that, but what is the hesitancy to doing that? It seems that the sponsors, for one reason or another, prefer to have a closed-end format rather than an open-end format, even if there's a discount.
Well, the closed-end format gives the portfolio manager an advantage in that they don't have to worry about cash coming in or cash going out. They don't have to have a percentage of the assets invested in cash. That's one benefit. Also the benefit of leverage. When we talk about low interest rates right now, clearly in an environment where you're only paying out on a floating rate basis, LIBOR plus a spread, leverage has been clearly beneficial. So I think when you look at the returns of closed-end funds over time, they've performed very, very well. It's a different investment vehicle than a mutual fund. Okay, it's a little bit more riskier because you have the leverage in there. The returns are different, and also you're getting the income stream, which I think is a benefit too. So I think there are features to a closed-end fund that an open-end fund doesn't necessarily get. So I think those with ETFs, they can certainly coexist, and I certainly suggest that they all be considered for your client's portfolio.
Yeah, I guess, and I know we're close to time, I'd just say, the cynic would say, of course, you like managing closed-end funds because they're captive assets and they're not subject to inflows and outflows. Investment teams would say they like managing nothing more than they like managing closed-end funds for, frankly, exactly that reason. They can take long-term views. They can invest in things that they might not otherwise be able to invest in an open-end format. discounts, as you note, are frustrating and can be frustrating. They do, though, come and go. There are times of opportunity, such as we had at the end of last year, where investors can just get attracted to the asset structure purely based on valuations. But in terms of a vehicle, I think we probably all up here believe that if you could ever solve the discount problem forever, I'd say more assets should be invested in the closed-end fund structure than are today, and hopefully long will closed ends remain.
I know we're down to time. Let's take 2 seconds. But if the end of last year didn't prove the validity of closed-end funds, nothing did. A mutual fund had to liquidate at the end of last year. Money coming back in. They had to give it cash. Worst time in the world to be getting out would have been then. You would have missed that whole ride coming back up, which the closed-end funds were able to enjoy. Whereas the mutual fund investor that cashed out, took their cash and sat there, waited for the whole first quarter to go by, they missed the whole opportunity.
We have a whole series of writings on our website under the moniker Stay Invested, and it's a true principle. The closed-end fund vehicle is an excellent long-term investment. They do produce income. Our funds don't use leverage. They're internally managed. They have a 6% distribution commitment that we have met or exceeded since 2011 when we implemented it. There is such a broad spectrum of opportunity under the closed-end fund structure. I mean, it's really worth delving into, and I'm backstop. The discount is a conundrum, and they constantly talk about, it falls back to investor sentiment, which is a way of saying we don't know. But I would suggest also one thing that you can look at is the correlation between NAV and the discount. That's a very helpful number to look at over time to see how closely they remain aligned. So you can get in, you can get the benefit of all your distributions, and you're not disadvantaged over time.
Thank you, Janis, Jonathan, Bob, I should say. Sorry about that. Looks like we're done on time, so I'm going to turn it back over to Nicholas. Thank you all.
Thank you very much. It was, I think, a very insightful opening to the day.